Hi everyone, I'm John O'Connor.
And I'm Jason Hyland from O'Connor & Hyland, Greater Boston Realtors, powered by Keller Williams. And John, we're here today to answer questions about mortgage rates in a changing real estate market.
So first of all, thank you everyone for sending us your questions in advance. From the many questions we got, we've chosen 3 questions for today.
Fantastic. Why don't we do question number 1, John?
All right, so our first question is, what is an adjustable rate mortgage? And following up, is it a good option in today's market?
So, John, an adjustable rate mortgage is a mortgage that is not fixed for the whole term of the mortgage. What I mean by that is if you get a 30-year fixed mortgage, you get the same interest rate for every year of the 30 years. An adjustable rate is fixed for a short amount of time, typically 3, 5, 7, in some cases 10 years. The rate then has the option to reset up or down depending on what the overall prevailing interest rate market is doing.
So in today's market where we have rates rising, does it ever make any sense for someone to go for an adjustable rate mortgage rather than just a fixed product?
Typical answer is it depends. I'd be very nervous because we're entering into a rising rate interest rate environment. The caveat there would be that if someone knew for certain they'd only be living in Boston or in that particular home for 3 or 5 years, yes, it could make sense because traditionally the rate you get on the adjustable rate is less than you would get for a 30-year fixed. There's a delta there.
But overall, in today's rising interest rate, it really doesn't make sense for buyers to go for an adjustable rate program because we know for sure that the Fed is going to be rising rates at least 2 or 3 more times.
I think that's right, John. If we were in a place where we thought rates were going to start trending downward, the adjustable rate can make sense because essentially it resets or refinances for you. That is not what we're anticipating in our current market.
So to sum it up on this question, basically we're advising our clients to go for an adjustable rate program. Not for an adjustable, but for a fixed rate program.
I think that's absolutely right.
All
Why don't we jump into question number 2?
All right, what have we got for question number 2?
All right, I get this one a lot, and it's how much down payment will I need?
That's a really interesting question. You know, historically, when I started in this business 25 years ago, it was just automatically assumed that you had to put 20% down.
Right.
And over the years, as the market heated up and as things were deregulated, it went from 20 to 15 to 10 to 5% to the ninja loans of 10 years ago. No income, no asset verification. But today, after the meltdown, things went back to 20% and they've loosened. So what do you think the average is now, Jason?
You know, it's a great question. I looked up some stats on this, and for first-time buyers in the entire country, it's about 10%. We've got some lenders that have programs with as little as 3.5% down to 5% to 10%, depending on the program and the needs and qualifications of the buyer.
Yeah, that 10% seems about right from what I'm seeing as well. But, you know, as you said, there are different programs out there. Yeah. So if you're a buyer, there are programs, say Mass Housing, where it's only 3.5% down,
yeah,
and you can still get into the market.
Yeah, and I think the thing people worry about is what's called mortgage insurance, which was an added cost if you put less than 20% down. But there are numerous ways to structure that, and in a lot of cases, you can actually refinance out of it once the equity of the home gets back to more traditional levels of 80%, 20%.
That sounds about right to me, Jason.
Cool. Let's jump into our next question.
All right. Our next question is, and our last question,
is it risky to waive my mortgage as a contingency?
Well, I've got some really strong opinions about that one, Jason, but I'll let you answer first.
All right. Well, I know you're the lawyer, but I'm going to do my best to give a legal answer on this. Yes, of course it's risky to waive a safety net or an out that you may have. In traditionally structuring an offer, a buyer is willing to pay X price, close in this time frame, and the offer would be contingent upon them, say, having a home inspection that was satisfactory and them being able to get their financing. When you waive that, you literally take the safety net away and the buyer's deposit could be at risk.
Now, that is an excellent answer, Jason, and I know over the course of the last 2 years that we have had clients who have waived their mortgage contingency. Can you explain why and under what circumstances that might be an okay thing for a client to do?
So we service a lot of different types of clients, from first-time buyers to high net worth individuals that are looking for trophy homes. If you knew with certainty that worst case scenario, you had cash available to make a purchase, yes, as a strategic move to win an offer, you have the option to waive the contingency and you're more attractive.
To jump in, do you feel that the market is the same now as it was 3 months ago? Do buyers feel that pressure to waive all their contingencies?
That's an awesome nuance to that question, because I think for the last 5 to 7 years it has been such a strong seller's market that buyers became desperate to compete, and as such they got reckless basically. The market has softened quite a bit in the last 3 months, and it's shifting more to a balanced or buyer's market. No, I don't think you need to waive that as a contingency.
Yeah, I would agree. Unless you absolutely have to in a competitive situation, I would not waive the mortgage contingency.
Totally, John. Well, listen, this has been a ton of fun. We really enjoy and thank you for sending us all of your questions, and we hope you loved this installment of Q&A with J&J.
Yeah, we'll be back next month to do another live show here on Facebook. So in the meantime, just go ahead and cue in your questions down below, and we'll be happy to take up your questions when we next meet.
Fantastic. Look forward to talking again.
All right, take it easy, everyone.